On December 4th, something happened in the silver market that should have been front page news across every major financial network. It wasn't a price spike. It wasn't a crash. It wasn't even volatility. Instead, something far stranger occurred. Silver disappeared. According to reported trading and vault data, nearly 47.6 million ounces of silver vanished from COMEX vaults in just 4 trading days. Not sold. Not transferred quietly between ETFs. Not explained. Just gone. That represents roughly 60% of registered inventory, disappearing in less than a week. And yet, CNBC didn't lead with it. Bloomberg didn't break into programming. Most retail investors never heard a word. I've spent the last 72 hours going through Bank of America commodity reports, cross-referencing COMEX delivery data, and studying London lease rate behavior. What I found doesn't point to a normal market fluctuation. It points to something far more uncomfortable, the possibility that the paper silver market itself is starting to crack. Before we go any further, a disclaimer. I'm not a financial advisor. This is not financial advice. I am not affiliated with any institution mentioned in this video. This is educational analysis based entirely on publicly available data. Now, let's start where most people stop. The story everyone thinks they know. If you follow precious metals, you've heard the story before. Silver is volatile. Silver squeezes fail. Silver bugs exaggerate shortages. And to be fair, historically, that skepticism hasn't been irrational. For decades, silver traded primarily as a paper asset. Futures contracts, options, ETFs. The physical market existed, but it rarely mattered. Because as long as paper claims could be settled without delivery, the system worked. Or at least, it appeared to. But to understand why December 2025 is different, we need to understand how the silver market actually functions. How the paper-silver system was built. Silver trades in 2 parallel worlds. World 1, paper-silver futures. Contracts on COMEX unallocated accounts in London. Synthetic exposure via ETFs. World 2, physical silver bars. Coins, industrial feedstock. For most of modern financial history, World 1 dominated World 2. At times, there have been 100 paper claims for every ounce of deliverable silver. That leverage worked because most participants never asked for delivery. COMEX, in particular, operates on this assumption. Only a small percentage of contracts ever result in physical delivery, which means the system remains stable. Until too many people ask for the metal at the same time. That's the weakness. And historically, whenever that weakness was tested, regulators stepped in, which brings us to 1980. The Hunt brothers and the first warning. In the late 1970s, 2 Texas oil billionaires, Nelson and William Hunt, began accumulating silver, roughly 100 million ounces, through futures and physical holdings. Silver prices exploded from $6 to $49, $45 in just over a year. But the system responded. COMEX changed margin rules mid-squeeze. Leverage collapsed. Forced liquidation followed. Prices crashed within weeks. The lesson Wall Street took wasn't that silver could break the system. The lesson was that regulators could always stop it. And for decades, that assumption held. But here's what changed. Silver becomes industrial, not monetary. In 1980, silver demand came from photography, jewelry, silverware, all discretionary, all replaceable. Today, silver is different. Silver is infrastructure. Electric vehicles, 25-50 grams per vehicle. Solar panels, 15-20% of annual supply. AI data centers, high conductivity applications, medical devices, defense electronics. Silver is no longer optional, and that creates a structural problem. Because industrial demand does not respond to price the way investors do. Factories don't take profits. They secure supply or shut down. The breaking point, December 2025. Now we return to December. According to vault tracking data published around December 9th, COMEX registered silver reportedly dropped from 229 million ounces to 138 million ounces by December 13th, a 40% decline in under 2 weeks. In my experience, studying commodity markets, this rate of drawdown is unprecedented. This is not slow depletion. This is not arbitrage. This looks urgent. And COMEX wasn't alone. London. The lease rate scream. In late October, silver lease rates in London reportedly spiked to 34.9% annualized. Let me explain why that matters. Normal silver lease rates sit below 1%. When borrowing costs jump from 1% to 35%, that's not volatility. That's what markets call a liquidity freeze. It suggests that banks and refiners cannot find physical silver, even at extreme cost. By December, lease rates fell back to the 5 to 8% range. But that doesn't indicate normalization. It indicates temporary relief, not resolution. Because lease rates behave like pressure gauges. They spike when the system is stressed, then calm before the next rupture. When paper promises lose credibility. In October, silver entered deep backwardation. At one point, spot silver in London reportedly traded 1.40 higher than front-month COMEX futures. In mid-October, backwardation reportedly reached 288. Some analysts called it the deepest since 1980. Backwardation in precious metals is rare. It signals that buyers want the metal now, not later. And when physical trades add a premium to futures, it suggests that paper contracts are being discounted for delivery risk. That's not normal. That's structural. The J.P. Morgan question. Now we reach the most controversial part of this story. According to reports circulating in December, J.P. Morgan allegedly flipped from an estimated 200 million ounce paper short to a reported net long position of up to 750 million ounces of physical silver between June and October 2025. If accurate, this would represent one of the largest repositionings in commodity history. Think about the incentive shift. Paper shorts benefit from suppression. Physical longs benefit from scarcity. If J.P. Morgan is truly holding that much physical silver, then they are positioned for a squeeze, not against it. Even more striking, some estimates suggest J.P. Morgan's COMEX warehouse now holds 150% of all deliverable silver. So the question becomes, what do they see that others don't? Shanghai Futures Exchange inventories reportedly fell to 446 tons in October, lowest since 2016, over 300 tons lost in a single month. When the world's largest manufacturing economy drains silver inventories at that pace, it doesn't signal slowdown, it signals front-running future shortages. The three scenarios. Scenario 1, grinding breakout, 45% probability. COMEX inventory falls below 100 million ounces. Lease rates sustain above 10%. Backwardation expands beyond 90-day contracts. Price path, $65 resistance, $70, $72 structural zone. Break above $75, opens $85. Scenario 2, parabolic shock, 30% probability. Requires COMEX inventory below 50 million ounces. Sovereign mints halt production. Delivery defaults or force majeure targets. $110, $140 by end of 2026. Historical parallel, 2011 silver, 165% in 4 months. Scenario 3, correction, 25% probability. Triggers, hawkish Fed, demand shock, inventory rebuild. Support, $55, $57, $48, $50 critical. Below $48 invalidates bullish thesis. Why this time is different. In 1980, leverage broke the squeeze. In 2011, ETFs absorbed pressure. Today, industrial demand cannot be liquidated. AI data centers don't unwind positions. Solar factories don't wait for pullbacks. This is structural demand meeting a fragile paper system. Silver isn't scarce on paper, but it may be scarce where it actually matters. When lease rates spike, inventories drain, and backwardation appears simultaneously, markets are signaling stress, not speculation. The most important silver moves may already be happening off-screen, inside vaults and supply contracts, not price charts. The biggest risk right now isn't price volatility, it's assuming the system behaves the way it always has, because systems only look stable, right up until they aren't. If you want updates when these 4 indicators hit critical thresholds, subscribe. I post community updates within 24 hours of major inventory moves or lease rate spikes. Comment below which scenario you think is most likely and why. I read every thoughtful comment and respond with additional analysis. Next video drops at the next inflection point. Until then, stay curious, do your own research, and I'll see you